Welcome to this online course on financial institutions and markets. I am Dr. Sonam Bhadoria, Assistant Professor at Swami Rama Himalayan University. In today's session, we will explore an important short-term financial instrument that plays a significant role in the Indian capital market, that is commercial papers. These instruments are widely used by corporations to raise funds efficiently and without relying on the traditional bank credit. So let's dive deeper into what commercial papers are, how they work, who issues them, who invests in them, and what role they can play in India's broader financial ecosystem. To begin with, imagine you are the chief financial officer of a large company and you suddenly need rupees 50 crore to manage your company's working capital for the next 3 months. Instead of approaching a bank for a loan, which might take time or cost more, you decide to issue a commercial paper. In these sessions, a commercial paper is a short-term unsecured promissory note issued by a company to raise funds for a specific period, generally ranging from 7 days up to 1 year. Since it is issued without any collateral, the investor depends solely on the company's credit rating. These instruments are issued at a discount to their face value and are redeemed at par value. The difference between the issue price and the face value becomes the investor's return. The concept of commercial papers was first introduced in India in 1990. The Reserve Bank of India brought it in as a tool to allow corporates, especially financially sound and creditworthy ones, to meet their short-term funding needs at market determined interest rate. This was a strategic move to reduce the corporate sector's dependency on bank credit and promote financial market efficiency. Since then, the use of commercial papers has grown speedily, especially among large corporates, non-banking financial companies, and other financial institutions. Now, let's understand the basic feature of commercial papers. These instruments are issued in denominations of rupees 5 lakh or multiples thereof. The minimum maturity is 7 days and the maximum is 1 year from the date of issue. They are issued in dematerialized form only, meaning all transactions take place electronically. No physical certificates are involved here. These instruments are transferable and can be traded in the secondary market, although the liquidity in this segment varies. Importantly, only companies that meet certain eligibility criteria can issue commercial papers. They must have a tangible net worth of at least rupees 4 crore, have a sanctioned working capital limit from a bank or a financial institution, and possess a minimum credit rating as prescribed by RBI. Now, who exactly can issue commercial papers? Well, the list includes companies incorporated in India under the Companies Act, all Indian financial institutions, primary dealers, and non-banking financial companies. Even mutual funds and insurance companies can also issue commercial papers, but they require explicit permission from RBI. However, these entities must comply with the eligibility norms laid down by the central bank, particularly with regard to creditworthiness, net worth, prior access to working capital funds. On the flip side, who can invest in commercial papers? A wide variety of investors participate in this market. These include commercial banks, mutual funds, insurance companies, pension and provident funds, and large corporate treasuries. Even high net worth individuals sometimes invest in these through pooled investment vehicles like debt mutual funds. However, retail investors usually do not participate directly in the commercial papers market due to the high minimum investment size and relatively limited market access. Now, let's explore the advantages of commercial papers for both issuers and investors. For the issuer, commercial papers offer a lower cost of borrowing compared to bank loans, especially when the company enjoys a high credit rating. The issuance process is also faster and more flexible, enabling companies to access funds quickly when required. Since commercial papers are unsecured, companies are not required to pledge any asset. For investors, commercial papers are an attractive short-term investment option, offering higher returns than traditional savings instruments or fixed deposits. The short maturity period allows flexibility and helps manage liquidity efficiently. However, all of these come with a certain level of risk, which brings us to the challenges associated with the commercial papers. Since commercial papers are unsecured instruments, the biggest risk is credit risk. The investor has to rely on the issuer's financial strength or credit rating. If the issuer defaults, there is no collateral to fall back on. Liquidity can also be an issue. While commercial papers are tradable, the secondary market isn't always active, which might make it difficult to exit an investment before maturity. Interest rate movements can also impact the pricing of commercial papers if traded in the secondary market. Additionally, if the credit rating of the issuer is downgraded during the tenure of the commercial paper, the market value of the paper may fall down, making it unattractive or resale. So, while commercial papers are efficient and beneficial, they must be approached by caution and the due diligence. Let's now look at the regulatory framework that governs the issuance and trading of commercial papers in India. The Reserve Bank of India regulates commercial papers and has laid down clear guidelines regarding their eligibility, issuance procedures, documentation, and reporting. Only entities with a strong credit profile can issue commercial papers, and the instruments must be rated by a credit rating agency registered with SEBI. Issuers are required to appoint an issuing and paying agent or IPA, which is usually a scheduled commercial bank. The IPA handles the issue and redemption of the commercial papers and ensures compliance with RBI regulations. Additionally, the issuance must be reported to the RBI through the IPA in a timely manner. If a commercial paper is listed, it also comes under the purview of SEBI, which mandates disclosure norms to protect investor interest. Credit rating play a vital role in the commercial market paper. A commercial paper can be issued only if it has been rated by at least one recognized credit rating agency. The rating indicates the degree of safety of the instrument, helping investor make informed decisions. In India, major rating agencies such as CRISIL, ICRA, CARE Ratings, and India Ratings. The research provides these assessments. Higher rated papers are perceived as safer and can be issued at lower discount rates, reducing the cost of borrowing for the issuer. However, it's crucial to remember that even highly rated instruments are not immune to defaults, as seen in the past financial crisis. To put things in perspective, let's consider a simple case. Suppose a large IT company like Infosys needs rupees 100 crore to manage its short-term working capital needs for coming 3 months. Instead of going to a bank and borrowing the amount of 8%, it issues commercial papers at 6.5%. Institutional investors, attracted by the lower risk and relatively better returns, subscribe to the commercial papers. Infosys gets its funding at a cheaper rate, while investors earn a higher return than they would from a traditional fixed deposit. On the due date, Infosys repays the principal in full and transaction is complete. This is a textbook example of a win-win scenario for both the issuer and the investor. The use of commercial papers in India has grown significantly over the past decade. Non-banking financial corporations, in particular, have active issuers using commercial papers to bridge short-term funding gaps. The market saw a major jolt in 2018 with the IL&FS default, which highlighted the risk of over-reliance on short-term instruments for long-term funding needs. This led to a more cautious approach from investors and regulators alike. Since then, the RBI has tightened norms to ensure better risk management and greater transparency in the commercial papers market. Looking ahead, the future of commercial paper seems promising but will likely evolve in line with the broader market trends. Technological advancements such as blockchain could make issuance and settlement more efficient and tamper-proof. Fintech platforms may also play a role in widening access and deepening market participation. With growing investor awareness and improvements in regulatory oversight, the commercial market is poised to become even more robust, transparent, and dynamic. To sum up, commercial papers are an essential short term financial instrument that allows corporations to raise funds efficiently while providing attractive returns to investors. They are regulated by the RBI and supported by a strong legal and operational framework. While they do not carry risk primarily due to their unsecured nature, their advantages in terms of flexibility, cost, and speed make them a valuable component of India's financial system. As with any financial instrument, the key lies in the understanding of risk, performing due diligence, and making informed investment decisions. Before we end, I leave you with a few points to reflect on. Why do companies prefer commercial papers over bank loans, especially in a tight credit environment? How should regulators balance the need for innovation and efficiency with investor protection in the commercial paper market? And lastly, should retail investors have easier access to this market, or does the risk profile make it unsuitable for them? Thank you for joining this session on commercial papers. In our next lecture, we will take a close look at the certificates of deposit. Until then, stay curious, keep learning, and continue exploring the fascinating world of financial markets. Thank you. Namaste.